So good afternoon, everyone. It's April the 22nd here at the Finance Memo. We're happy and honored to be having two guests today, Mr. Spier and also Mr. Abdulaziz Alnaim with us. So we are honored, me and Wa'il, and it will be a very enjoyable talk. First, we would like to ask both of our guests if you can give us more about yourself, some background information, what got you into investing in finance?
Aziz, can I ask you to go first? Are you okay with that?
Whatever you prefer. I was going to ask you to go first. I think well, you wrote a book about us. You definitely have the more interesting story. So
my background is that I was I graduated business school, a greedy and arrogant piece of work. And I went to work for an investment bank in New York, where the people that I worked for were not good people. And it was really very, very similar to the place Wolf of Wall Street, the movie Wolf of Wall Street. And it took me about 18 months to realize that I needed to get out of there. And I was very unhappy. And I knew that something was wrong, but I kind of felt like succeeding in business required me to be as dishonest and sleazy as they were being. And during that time, I was lucky enough to walk into a bookshop. The actual office that I worked in was on Wall Street. And I went into a bookshop near to Wall Street. And one of the books that I picked up was The Intelligent Investor by Ben Graham. And I read the book first, and it made so much sense to me. And then I read the introduction, saw the introduction was by this dude, Warren Buffett. And so I went and learned more about Warren Buffett. I found that there was a biography of Warren Buffett, the Lowenstein biography of Warren Buffett. And as I read that book, I found myself getting more and more envious of this man, Warren Buffett, and the more and more I realized how much I hated my life and how much I liked Warren Buffett's life, because I was expected to lie, cheat, and steal for a living, basically. And here was a man who was not lying, cheating, or stealing. He was just being honest and telling the truth. And he wasn't selling, I was required to sell bad investments to people who couldn't afford to make them. And Warren Buffett was not doing that. And so I started asking myself the question, how do I get from where I am to where Warren Buffett is? And that was a very, very slow process that in a certain way is still continuing. And, but that was the beginning. That was my beginnings as an investor. And I cannot believe that is already almost 25 years ago. So time flies when you're having fun. But how's that for a start?
That's a great start. I've personally read your book. I would say it's one of the most authentic books I've read in a while. It's very nice. So we'd like to move on to Abdulaziz. You have a I'm very surprised that a Saudi manages money in London. So could you tell us more about how you started? What drove you to go to London to manage money?
So my story started, it was in the year 2000. And I was studying electrical engineering and computer science at MIT at the time. And I was on a summer holiday flying back to Saudi. And I had taken, I had a layover in London, and I had a few days that I'd added to that layover and met some friends here. And one of my best friends, who actually sits on our board right now, Sir Al-Blahid, had just come from New York, and he had participated in this course that Merrill Lynch did held for their clients. And he came back and he was talking about stocks and the stock market and this guy called Warren Buffett. And I knew a little bit. I actually worked in a bank in Saudi when I was in high school. So I wasn't completely unknowledgeable about finance, but I didn't really know much about the stock market specifically. And so he recommended a couple of books and kind of got me interested in the idea. And I flew back after the summer back to Boston. And I remember I went to the Harvard bookstore in Harvard Square, and I picked up walked in there and went to the finance and investment section. And just keep in mind, this kind of was the peak of the dot-com bubble. So don't judge me when I tell you the titles that I bought. And I walked in and I went to, like I said, to the stocks market section, and I bought several books. The first two were ones that Saud had recommended, The Warren Buffett Way and Peter Lynch's Went Up on Wall Street. And then the other two books, one was called Day Trade Online, and the fourth book was something about technical analysis. I can't even remember the title. And to this day, I swear I have no recollection of why I decided to pick up Peter Lynch's book first. And it may have been dumb luck or divine intervention, call it what you want to call it. But I just read that book, and at the end of that book, it made sense to me. Something clicked in my mind, and the whole thing sounded really interesting, and it just really, really fit. And I never read and then I read The Warren Buffett Way and kind of learned more about Buffett, and then went on to basically read. I went to the MIT library, picked up every book that I could on stocks and investing, and just kind of went down that path, just teaching myself along the way. And I never read the other two books, but I keep them deliberately on my shelf to this day as a reminder of the role of luck in our lives. Because I could easily see at the time, had I read the other two, my life would have gone in a very different direction. I may have been a very different investor. All sorts of things in my life would have been different. So I think, and not to mention that the whole story started with, like I said, my friend telling me about it. Happened to be that he was there when I had stopped in London. So I don't know, luck matters a lot in life.
Yeah, but if you don't mind me stepping in and adding to the part of Aziz's story that I've seen, is that I think that, so, I've been attending the Berkshire Hathaway meeting for probably more than 20 years now. And over time, I start noticing this guy, Aziz, who's hosting meetings for other investors. So he doesn't just go to the Berkshire meeting. He finds people who are looking for other friends, and he hosts meetings for them. And then I start reading Aziz's annual report. And I don't know how I got onto your list, Aziz, but suddenly I saw somebody who totally bought into the Berkshire Hathaway way, and that Aziz was communicating with his investors in the same way that Warren Buffett would communicate with his investors, in that Aziz was telling investors what he would want to know if he was in their shoes. And then Aziz, I don't know how you ended up coming to my investment conference or the Value X group, but Aziz again distinguished himself because he didn't just attend, he started creating groups. So Aziz is a less enthusiastic skier than some of the other people at the conference. So he started organizing walks up to a mountain hut. And so I really have to tell you, Aziz, you're an extraordinary leader in the field, and it's great to watch you. Forgive me, I had to add that because Aziz is quite modest, and he's not going to say
guy, you're too kind.
So in any case, I wanted to add that to Aziz's story.
Thanks, you're very kind.
So that was a great start from both of you guys. So I would think you both label yourselves as value investors. You could correct me if I'm wrong. So what led you to having this kind of philosophy in investing? Has that changed the way you invested before and after you started calling yourself a value investor? We'll start with Guy.
Yeah, and what I would say is that the way it happened for me is that I wasn't actually interested in investing. I didn't really understand it and didn't think that that was where the action on Wall Street was. I knew that I was interested in Wall Street, and I had this idea of becoming an investment banker, investing in startup companies. And it was only because I discovered Warren Buffett that I became interested in investing. I realized that that was an opportunity to live an extraordinary life. So it was not like I woke up one day and said, I want to be an investor, and then sometime later said, oh, I've found my philosophy, it's value investing. I discovered this philosophy of investing and actually of life and said, this is the life that I want to lead. And so in a certain sense, I've always been a value investor. I think that today, life is far more difficult. I think that at the time that I started, it was very easy to do simple kind of analysis and simple kinds of screens for cheap companies. And there were so many people, somebody as smart as Aziz was picking up books on technical analysis. So there were many participants in the market who didn't have the right ideas. And today, all the participants in the market have the right ideas. And so in a certain sense, everybody's a value investor. Everybody's a fundamental investor. They all understand that technical analysis isn't really going to help. Analyzing the business is going to help. And then there are different philosophies of how to go about doing that. And I think that for people like me, I think it's quite difficult because I spent so long teaching myself a very basic and simple kind of analysis in terms of getting to good investments. And that analysis probably doesn't work at all anymore. And I need to adjust to new ways of looking at the world, which don't come easily to me. So there's my little potted answer. I don't know, Aziz?
Well, I think Guy kind of really touched on the big points, I think, and I don't have a lot to add, but if I'll add a couple of small things. One is, and I think Guy really hit the nail on his head when he said everyone is a fundamental investor. I think the people obsess a lot about labels and, oh, this is a value investment or not a value investing, or is this value investing or not? And the more I spend time in doing this, I think the more I realize that labels are not helpful, and you really need to kind of think about things in a more nuanced way. And so kind of that's kind of one part of it. And I think everyone would define value investing as well. Even if you talk to all the value investors, they'll tell you their definition is different. Or at least even if they don't, if you look at what they actually do, you'll find that there's it's a big spectrum, and a label makes it sound like it's one thing and only that one thing. To me, at the heart of what value investing is this idea that you want to buy something for less than it's worth. This kind of bargain hunting mentality in a sense. And I think that there are many ways to do that. And there are old ways that Ben Graham in a way kind of just explained one way of doing it through example, but there are probably many ways. And I think at the heart of it is that philosophy of just buying something for less than it's worth, or buying something when it's on sale. And to me, the reason I became a value investor, I think, is, well, I'm gonna invoke a stereotype in Saudi, but my family comes from this region in the middle of Saudi called Qasim, and it's known for a history of frugality and bargain hunting, and I think it's something that people think it's DNA, but I don't think it's DNA. I think it's just you grow up with that kind of that culture instilled in you, the idea that kind of bargain hunting is a good in and of itself. And I think to find an investment philosophy that kind of just really fit into that mentality when I was younger, and just the idea that there's something special about finding a bargain, that it kind of it scratches that itch, I think is part of it, and which I think to this, which takes me to another thing that I think the more I spend time, the more I believe in, is you really need to find a way of investing that fits your personality. And I think we're all different, and we all approach the world in different ways. And it's something that I know Guy talked about a lot in the past in different venues. And I think he's absolutely right about it. You really need to find something that fits your personality. Otherwise, it won't work. If you're doing something that doesn't fit you, sooner or later, A, I don't think you're going to succeed, and B, I think you're just going to be miserable.
That was well stated. And to be honest, during the past couple of months, with all this madness in the market, we've seen a lot of young investors trying to label themselves between value, growth, and all kind of different labels. So touching on that question was great, to be honest, and it adds great value to our listeners. Another question that we've seen a lot of people having misjudgment in it was, what's the actual definition, or how would you differentiate value versus deep value? Like, people are asking this question a lot.
Can I allow Aziz to go first this time?
Of course.
Is it because it's a hard question, guy?
Absolutely, Aziz. Absolutely. I want to be able to say, once you've given the definitive answer, I want to be able to say I have nothing to add.
I think I kind of partially touched on it, this idea that I think deep value is one incarnation, one example of value investing. And I think it happens to be the one that Ben Graham started with. When Ben Graham did not invent something new. He did not actually invent the philosophy. He was just the first to, I think, put it to paper. I think the idea of buying something at a bargain is human nature. And to some degree, I want to say you're almost born a value investor. I know it might be, can you learn value investing? I would debate it. I really think that if you don't have that itch to buy something at a bargain, it's very hard to teach you that. So, and to me, that is the bit that is value investing. I think everything that happened around it. So Ben Graham came and said, okay, in the world where I live today, this is how I find bargains. And it was easy, but at the same time, actually, with the information that he had available at the time, the types of businesses that were available at the time, I doubt they could do it any other way. And I think the world evolved. And part of it, like Guy talked earlier about, the competition became harder. But basically, when Ben Graham was doing it, he was trying to use something that no one else was doing. And that's where you're going to be able to find advantage. And that gets harder over time as more and more people compete. But to me, value investing is just one example of applying the philosophy.
And I would just add that I think that people like Aziz and I don't want to get too hung up on labels. And so value versus deep value, as Charlie Munger said, all value investing is intelligent investing. And as Aziz said, it's paying for something that is worth more than what you paid for it. And how we get there, I think that, again, the label is not important, and there are different ways of getting there, and different people with different personalities get there in different ways.
I just wanted to add on Abdulaziz's point about Qasim region. I'm also from a Qasim region, so it might be a big stereotype that you are all value investors. So I wanted to ask both of you, what specific characteristic or factor would you give the most weighting to when you analyze a business? Is there something you would put or you would analyze first, or is there something that you give the most importance to?
I'm going to let you go first again, Aziz, if you're okay with that.
Oh, that's a hard one. I'd probably say that's the hardest question for any investor. To me, and this might be, I would split into two. I'll answer in two different ways. So the first way I will answer it is, the first may not be the most important thing. Actually, when we invest, what we always try to do is find reasons to say no. So we call the first phase of our investment process killing the idea quickly. It's not the most important part to make a decision, but it's the most efficient way of avoiding mistakes and kind of managing our time to focus our time and energy on what matters. So we focus first on what's bad, whether it's, the way we do it is two ways. We run a set of quantitative tests that are based basically on published accounts. And we hope that it points us to either evidence of accounting manipulation or deterioration in the business, or something really wrong that allows us to say no in 5 minutes and move on to the next idea. But it's not actually the most important. It's just the efficient way of approaching it. At the essence of what we want to do, I think, is answer, because we own things for many, many years, the majority of the capital of the company that we're going to end up owning in 5 or 10 years is going to be capital that was generated through free cash flow and reinvested in the business during our ownership period. So for us, the most key question to really figure out is, what is the incremental return on that capital that will be deployed in the business during the time of our ownership? And that is really the key question. And to answer that, I think you do 1,000 things. And historical return on capital is one clue that will help you answer that question, but it's not enough. And what management has done in the past and their behavior is another clue that will help you think about it. The industry conditions and dynamics, what's happening in the world, all of these things feed into that incremental return on capital. And the competitive advantage or the economic moat that surrounds the company and the business are, again, one block in that question. If you do not have a competitive advantage, if you do not have a moat, you cannot earn higher returns on incremental capital for this many years that we want to own it. So all of these things help, I think, to us at least, really answer that question. What kind of incremental return on invested capital that we're going to get over an ownership period of 5 or 10 years? Guy?
Yeah, that's extraordinarily well put. And I think that there are a number of investment firms, fewer than one would expect, that have really excelled and succeeded because they had a sort of like a focus on that idea. And if you pay attention to Aziz's firm, you'll see that it is succeeding because of that. And I urge you to read his annual report, because Aziz doesn't pay some PR firm to write the annual report. He sweats blood and tears to write the annual report himself. You get exactly the same person who was speaking just now you get in the annual report. It's very, very worth reading. I think that the one thing that I would add to Aziz's point is that I think that, and Aziz, you studied engineering, didn't you? You said just earlier, and I didn't study engineering, but I think that much of my mind works like an engineer. And as engineers, we like to look at things. We don't necessarily like to focus on people. And I think that something that I would like to have changed over the last 25 years, and I certainly will change over the next 25 years, is to combine that analysis with trying to find those companies that have those economics, but also have a manager that understands those economics. And it's amazing, because when I was at business school, we had a professor of organizational behavior. And what he said was that all of the technical things that we were learning, by about 10 years into our career, they wouldn't be important. And all that would remain that was important was our relationships with people. And so I think that another level of analysis that I can ask you, Aziz, if you do it, is not so much do you and I understand it, but does the manager of the business understand his economics, and is he pulling the right levers in order to make the economics work for the shareholders? And, you know, if I'd have understood that Jeff Bezos understood those levers and was pulling them in the right way, my investing history would have been different. But over to you, Aziz, before we give the mic back to Wael and Abdullah.
Yeah, first, let me correct to my mother's great disappointment. I'm 6 courses short of that engineering degree. I started taking those finance and economic courses as electives. And then in my 3rd year, I discovered that I was ready to graduate. And by that time, I completely lost interest in computers and engineering. And so I went to the registrar in my last year and just changed my degree and graduated. And and never lived that down, but he's inside the family. But on the issue,
I'm happy to tell your mother that she has to forgive you for that, and her son turned out just great.
No, the reason I need to correct this is at some point someone had sent a letter at home and it said engineer and my name, and that kind of brought back kind of memories. Anyway, on the issue of management, I think Guy is absolutely right. I think, and I find that it's more in the negative. I just find that what you want to really spend time trying to avoid. I don't know that I'm good enough to find someone who is the Jeff Bezos equivalent or anywhere near that. I hope that over time we've become better at spotting people who destroy, who basically are the negative version of it. I find that in many cases, you've got a wonderful business and that management is actively destroying it through bad decisions. One of my friends, Sean Stanton at Ensemble Capital has a term that he calls it mortgaging the moat. And I think it's a wonderful expression and frame of work. Basically, are they actually, because I think managements, at the very least, you expect them to do the best that they can in protecting what's there already. And every now and then you're going to have someone like Jeff Bezos who's just absolutely out of this world and can do a lot more. But I think by just at the very least identifying the people who are the anti-Jeff Bezos and avoiding them, I think that of itself adds a lot of value to your portfolio over time.
Yeah, and Abdullah and Wael, in talking about that, Aziz is sharing an idea that can't be shared often enough by Charlie Munger, which is when Charlie Munger's asked why he's so smart, he often will answer with something along the lines of I'm just trying to avoid stupidity. And what I got the sense from you, Aziz, is that in a certain sense, even if you can't identify the best managers, if you can just avoid the worst, you're already in a great place. And just to, Abdullah and Wael, if I think of one of my very worst investments, which was a zero in a company called Horsehead. The management, they weren't just mortgaging the moat; they were kind of like pulling it apart, and you kind of ask why, and we assume that people behave the way we would expect them to behave, and some people, even smart people and well-meaning people, can behave extraordinarily, as we see. If I don't know how closely you follow affairs in the UK and in Europe, but we saw, as you know, Credit Suisse lose an enormous amount of money, and you just ask, why were they doing that? And similarly with the way, well, we'll stop because we don't want to malign people, but back to you, Abdullah and Wael.
Definitely what happened with Archegos was huge. It was like an earthquake for the entire financial industry. So another question that a lot of people get stuck into it is the current market conditions is giving us high valuations. The market is expensive. So while operating and investing in these conditions, what's a sound strategy to do? Do we stay in cash? Do we avoid the market? How do we find companies that are not overvalued in this crazy market?
I definitely want Aziz to answer this first because I'm struggling with this question myself. Aziz?
You're killing me here. You're killing me, Guy. So there was, many years ago, Guy said something that really resonated with me. And he said, when you try to time the market and hold a lot of cash, God looks down on you and says, let there be a bull market. And many people have said that. And I think Peter Lynch has said that timing the market, I'm going to butcher his quote, but timing the market is better than timing the market or something like that. It's a hard question. I think on the one hand, ideally you want to hold your positions as they are forever. And on the other hand, I think you really need to think of, well, it's basic economics. opportunity costs and what kind of returns on investment that you can get, not only today, but in the future. So holding cash, I think sometimes is basically a way to say you're basically saying my future return and my return on future investments, which I will be able to purchase now that I hold cash, is higher than what I have available right now. I think it's a particularly hard one, and one that I think everyone in my circle at least struggles with, especially if you manage an open-ended fund. And to me, not a lot is written about this, and I don't claim to know the answer. But I think when you manage an open-ended fund and people are coming in or leaving at any moment in time, the cash that they bring in or leave, you cannot let it be the decision maker. You cannot outsource or delegate your investment decision to the whims of subscriptions and redemptions. And so when we get any money coming in or going out, we always kind of prorate as long as the amount isn't kind of trivial, and force ourselves to actually make decisions as opposed to just kind of, if a lot of people come in and let the cash accumulate. To be completely honest, the way we think about cash is just everything that we own has a price that we'd be buyers and a price where we'd be sellers. And everything that we follow that we don't own has the same. And in times where valuations go up, like the past couple of months, our process is telling us to sell a lot of things, and our process is telling us to buy some things, but not as much as the things that we're selling. And so kind of cash goes up. And then when the flip side of it is in March of last year, we had a lot of cash because the same had happened leading up to it. And then at the end of March, everything was hitting our buy price, so cash went down. So I think there are many ways of answering it. Perhaps what I would say as a conclusion is find something and be consistent about it. Just have a framework that you're consistent about. And it's going about and trying to just time the market based on whim is definitely something you want to avoid. But just have something that is more systematic and stick to it, I would say.
I have nothing to add.
Being systematic, it removes all the emotion that is in investing. So that's an edge that you can use. Studying Buffett, I found that he uses leverage through his insurance float and something like that. So what are your thoughts on using leverage as an investor to enhance returns? Should we use it? Should we avoid it? Why and why not? Especially that rates are extremely low right now.
Guy should definitely answer that one. I'm going to jump in.
Aziz, you know we don't have him on the call, but you know I'd like to ask that guy who ran Archegos what he thinks of leverage, if it's a useful thing or not. I think that he has some very good answers for us, and he has the only answers. I would tell you, unrelated to investing, the last time I had leverage in my fund was in 1998. I was leveraged 10%, or I had assets to 110% of the value of the equity in the fund. It's the only time I've been leveraged. And I know that the market or the stocks that I owned going down 90% would have been an extraordinarily unusual event. But if they had gone down 90%, I would have wiped out my investors, myself, my family's net worth, and it would have been a disaster. And let's not forget that the guy who was running Archegos, he thought that the kind of event that would take out his fund would never happen. Neither did the guy who was shorting GameStop, which is, in a certain sense, another kind of leverage. And there's a chart, I can share it with you afterwards. You can look on the English Wikipedia entry for long-term capital management. And, you know, at the time that I was a new investor, and those guys were the geniuses on Wall Street, They knew what they were doing. They were the masters of the universe. And you see in this chart how they outperformed everybody for like 5 or 6 years. So not like just a few months, 5 or 6 years, they were looking smart. And then in the course of 3 months, they were wiped out. And suddenly my returns, which I felt were very modest, were way better than their returns because they were a big zero. So I've become absolutely adamant that leverage in any way, shape, or form is just unacceptable. And I would tell you, if we go outside of investing, I recently bought with my family a home in London. And because I don't live there full time, I was having the biggest trouble getting a mortgage on the property. And the bank was giving me more and more problems. And eventually I gave up and just decided to buy it for cash. And then after the purchase, the bank came back and said, oh, actually, we can give you the mortgage. Do you want it? And I was so pleased to be able to tell them no. So I think that even if one can possibly do it in real estate, not to have any leverage. And that's a very different kind of leverage, because in the case, it's, just to get into the technicals a little bit, usually when you lever the securities, the bank that you're borrowing the money from, or the brokerage firm, has these very, very powerful protections that allow them basically to take control of your shares and sell them from underneath you if they decide that the market is going against them. Actually, interestingly enough, something that in the case of Archegos, I think that things moved so quickly that Goldman Sachs was able to get out before things went below zero. But what happened with Credit Suisse is that they didn't move fast enough, and suddenly they had their positions in a negative. When it comes to real estate, most countries, or many countries, have rules around mortgages that even if the value of the property drops below the value of your mortgage, they have to allow you to work your way out of it. So it's a far less dangerous source of leverage. But even in real estate, I think that we should all try and get to the place where Warren Buffett is. He bought his house on a mortgage, and now that mortgage has been run down to zero and he doesn't have any debt on it. And if I may do a quick run on, and I'll just give you a kind of a sort of a window onto the kind of conversation that Aziz and I will have in all sorts of ways. So there's a company called American Tower, and I was having lunch with a mutual friend of ours in Austin with Monish Pabrai and another person who pitched American Tower to us. American Tower is an amazing business. It's amazing for all sorts of reasons, and that the main one being that when you put up one of those cellular phone towers, you can resell that multiple times because you can add different phone companies' transmission equipment onto it. So unlike a piece of real estate, which you can only rent out to one family, this is real estate that you can rent out to multiple families. And the only problem with it is that it's extraordinarily leveraged. And I asked the guy who was pitching the stock, I said, it's a wonderful business, but why on earth do the people who run it have to lever it so much? They could have an extraordinary business and not leverage it very much. And there are some businesses like that. And I'll give you another one, and I hope you don't mind diving into specific names. It doesn't happen to be cheap, but the guys who control and run WD-40, I'm sure that even, it's an American brand, but I'm sure you find it in Saudi, you find it all over the world. It's this lubricant, the special lubricant, a branded lubricant. And they run the company with no debt. They just can't be bothered with the debt. So at all levels, the answer is don't lever up. And I see Aziz nodding, so I'll give you the last word on it. I'm sure you have something to add.
Well, I don't have a lot to add. Actually, I don't have anything substantial to add. But to Guy's point, and I've only seen one analysis on it. I haven't done, just for the record, I haven't done the analysis myself. But the LTCM portfolio, which was taken over by a consortium of Wall Street banks, actually made money in the end. So they blew up because the world in '98 worked. There was a short period of time where things really worked out against them, and they were a forced seller. They had to sell at that moment in time because of the leverage. And had they had the opportunity to hold that portfolio for a couple more years, they were proven right and made money. And I think that's the problem with leveraging securities, that the world is so unpredictable that you could be a forced seller. You could be right about the thesis. You could be absolutely 100% right over time, but you could be taken out through a margin call midway. So from point A to B, you make money, but in the middle, something happens and you get liquidated, and it doesn't matter that you were right. So I think that's kind of the main argument against leverage in these situations. And
Aziz, there's a term that I've now learned. A mutual friend of ours, William Green, has written a book, Richer, Wiser, Happier. And Abdul and Wael, if you want me to make the introduction, I'll be happy to. But I'm now going to tell Aziz this, and I hope you put it into your annual letter because it's wonderful. And I don't remember which investor William Green was interviewing, but he talks about resilient wealth creation. So, if you go to the casino and you happen to gamble on the number 18 and it comes up number 18 on the roulette table and you make all this money, that was wealth creation in a certain way, but it's not resilient. If you keep putting your money on the roulette table, eventually it'll all be taken away from you. And then there are people who engage in resilient wealth creation. And I'll give you, just forgive me, because it's so much easier to talk about specific companies. I mean, we all know the example of Berkshire Hathaway, which has been resilient in its wealth creation, but there's a company called Allegheny, which is run by the former insurance analyst of Sanford Bernstein, and whose name, Weston Hicks is his name. And Aziz, it's just quietly and resiliently growing wealth for a group of families. And a couple of other investors that Aziz and I know, the guy who runs the whole of the Markel Insurance Company, somebody called Tom Gaynor, I think is a resilient wealth creator, as is Tom Russo, who is a big investor in Nestle and a few brands. So I'm not sure why that is relevant, but it felt relevant in the moment. Back to you, Abdul and Wael.
But actually, yeah, and to Wael, I think Wael mentioned that Buffett has leverage, and actually he doesn't. If you actually look kind of under the hood, the debt that is on Berkshire's balance sheet is non-recourse debt. So if someone is willing to give me non-recourse debt, I'll take it. It means debt that can never be called back, effectively back to you. It's very, very rare that you find yourself in a position where that happens. Berkshire is able to do it through their regulated utility entities, where basically it's debt and no one can ever come and say, pay us back effectively. So it doesn't impact the rest of the company. And I think that's a key difference. So Buffett built what he built without debt. It's just that indirect leverage is not the same as actual leverage that most people would get into trouble by taking on.
Yeah, thank you, Aziz, for reminding me of the question. And another aspect of the leverage at Berkshire is the insurance float. And what is key is, so I will tell you, I don't remember his name, but there was a guy that I met who he thought the right way to make money was to trade in options. And he had a rather large fund trading in options. And again, there was a freak moment and then the brokerage firms had the right to sell the options from underneath him. And if they would have waited like half a day, all of the pricing would have put him back into a very profitable position. But they decided they weren't going to take any risks on his portfolio, because if you do, you get the result that you got with Credit Suisse and Archegos. By contrast, if you have leverage that's created by insurance floats, so people who want an insurance contract pay you premiums, you hold their cash, and depending on a certain event in the world, you might have to pay out. The key there is that they can't come and ask it for you when they get nervous and uncomfortable. A key event has to happen in the world, like a hurricane or an earthquake or a fire, and that will be uncorrelated to what's going on in the stock market. What happens when you have a LTCM is that the things are correlated. People don't believe that they are, because they'll show you 100 years of data and they say, look, it's not correlated. And then in year 101, it becomes correlated for exactly 5 minutes, which is the 5 minutes you didn't want it correlated. So I mean, look, Aziz and I think I'm speaking for you, Aziz. We admire Warren Buffett. As Aziz said, it's a genius to be able to get leverage in a way that it's not going to come back and bite you. And we would leap at that opportunity. And maybe we should have more conversations about how to find those opportunities, Aziz, because I think every now and then they do exist. I mean, before Buffett was doing insurance, he had this company, Blue Chip Stamps, which was trading stamps, which created float. It wasn't insurance float. And originally, American Express's business, I think that all three of, other than me, all three of you are perhaps too young to remember traveler's checks. Or maybe you remember your parents going to the bank and getting traveler's checks.
Sadly, I do. But
well, those if it was an American Express issuing those traveler's checks, that was float. And that was very, very good float. Having said that, by the way, and I hope I'm not getting too far off topic, a business that I looked at and was actually owned for a very short while was a company called MoneyGram. And there's another company called Western Union, who were in the business, or perhaps still are in the business, of doing international transfers for people who don't have bank accounts. And they would generate a lot of float, not through insurance, but through the fact that there was kind of 2 or 3 days that they could hold on to the money between when it was deposited and when they had to deliver it. MoneyGram got into big problems because they invested that float very, very badly. But so some kinds of leverage, if you're really smart like Warren Buffett and you figure it out, are probably okay. But that doesn't mean that all kinds of leverage are okay. In fact, most kinds of leverage are really, really dangerous.
I can definitely relate to both opinions about leverage, and that was insightful for a lot of young investors. They would be looking into leverage and thinking they would beat the market in a way. So our next question is, with this huge influx of new investors in 2020 and first quarter of 2021, we saw a lot of portfolios going up in terms of these young investors, unseen profits. So my question in portfolio management would be, what's the optimal or best practice advice you can offer for these investors? If they, like, what would you do when a stock you own outperforms in a way that you never expected? You trim it, you sell it. What would you do?
I think that many people have said that the selling is a far more difficult thing than buying. You know, it's and so one answer is that you try and buy stocks that you never have to sell, because selling is so hard. You want to just buy and hold forever. And I think that some of the investors that I admire the most, like Charlie Munger or Li Lu, that's what they do. They buy and then they just sit on it forever, and they go through enormous swings. And even Monish Pabrai, who has not espoused that philosophy, I think more recently in some of his talks, he's kind of said that was not the right approach. The best approach is to just buy and then leave it alone. But and that gets rid of the problem completely. And you know, and Aziz, you'll take this next, but somebody else that I don't remember who it was said that, you know, buying a stock is like getting married. You know, so it's this beautiful celebration and you're so exciting and you talk about the bride and how wonderful she is. And then selling a stock is like getting divorced, and it's never happy. It's never easy. There's always problems. And I think I realize that this is a non-answer to your question, but in a certain way, I think that the non-answer is just saying, look, it's extraordinarily hard. It's extraordinarily hard. And, you know, Charlie Munger has said, if you thought you were going to find this easy, you better find something else to do. There's a reason why it's hard. And you're asking a great question, but there are no easy answers to it, except that Aziz might have been able to think one up. So tell me, Aziz.
No, I think it's one of the, for some reason, it's a great question because it's also one of the least discussed topics. I mean, you pick up investment books time and time again, people telling you this is how you should buy and this is how, and very people actually talk about selling, and it's very hard. And I don't know that there is in so much that there is a right answer for everything. There probably isn't. I would say that, and I know you did actually touch on it in the question itself. It's easy to sell when the fundamentals of the company were not easy, but easier to know that you should sell when the fundamentals of the company deteriorate or something fundamental to the business happens. I think selling purely on valuation is a very, very, very tough thing to do. I found that there are probably only 2 times where it's the right thing to do, and I'm not claiming that I've not regretted it in some of those times. The first one is if you find something else, you don't have cash, you find something else that is really, really attractive and you've got a lot of confidence in it. But only if the disparity is really wide, and that's like where you really look at something that you've owned and want to own for a very long time and say, the upside here is relatively limited compared to this new idea I also like, and the upside is much higher. It's easier said than done, but I think that's probably one of the easier times to sell purely on valuation. What we've done in the past is just when it's gone up too big in our portfolio, we have actually triggers, and above a certain level, we start trimming it. It usually actually never ends up exiting because the price corrects them. But if the valuation gets really extreme and if it gets too big of a percentage of our portfolio, we will trim it. And the reason we do that is back to the other comment that I made. I think if you run an open-ended fund, you're buying and selling your portfolio to people as they come in and out every month, or whichever your NAV frequency is. So you're doing it whether you like it or not, is I guess what I'm trying to do. And it's better to do it consciously than do it through delegation. But I don't know that it's an easy thing to do.
I'll just give you one, and this is an obvious one, but perhaps the easiest sell decisions that I've come to have been where I realized that the management team was not who I thought they were. And I realized that they were no longer working. There was a severe conflict between the way they saw the company and how to run it and the way I think they had to run it for the shareholders, or sometimes and unfortunately in some cases it's happened too slowly, where I just can't believe that they've done what they've done. And so I kind of sit there holding on to it, believing that somehow something will change. And so that ought to be an easy decision. I think that I've also experienced this idea that I see the management doing something that I don't like, but somehow I think that I'm going to get the better of them in one way or another. And the management, and they're in control of so many things. They're in the control of the flow of information and all sorts of other things. And the investing in public companies game works because the management team, it will only work if the management team with the companies we invest in are playing the same game, meaning that they're not here to make money from the investors or because they duped the investors. They're here to make money because they want to make money alongside their investors. And there are many management teams who are like that, but there are a significant number who are not. And there are a significant number who pretend to be that way, who actually aren't. And it's inevitable. I mean, Warren Buffett, he had an investment in an Australian publicly traded insurance company that ended up having quite a bit of fraud in it. And so that is one example of an easy sell, if you like, even if you're selling at a loss. So, or I guess another one would be simply that you got it wrong. And I think it was fascinating to see Warren Buffett at the beginning of the COVID pandemic selling all of his airlines. He just said, I got this wrong, because I think that, I mean, he didn't really share his analysis with us, but I think that what he'd said to himself was that he only wanted to invest in businesses that are good for all seasons, if you like. And to go through a season of 2, 3, 4, 5 years with significantly reduced demands and high fixed costs and appealing to governments for help was not the deal that he signed up for. And it was not a consideration that he'd considered when he invested. And when he realized that that was an assumption that he'd made that he'd gotten wrong, he just sold it. And I have an enormous admiration for that, because it's so much easier said than done. And it's one of the reasons why I try to talk as little as possible, especially in front of large groups, about my investments, because I think it becomes much harder to take those kinds of decisions. And I mean, there are many decisions I've admired him for, but that's one that I admired him for a lot.
And I want to say to guys.
No,
Sorry, go ahead.
No, you can go ahead. I just wanted to add a quick comment about how the airlines, a lot of people are saying Buffett did it wrong since they went up in value, which we do not agree with.
I think the challenge, perhaps the most difficult reason to sell, and I don't know if that I've ever actually successfully done it, is you own something and it goes up for a reason that you did not foresee. And to realize at that moment in time that you had the wrong assumptions and you were just through dumb luck, stock went up. The right decision intellectually to do is to actually sell, because you've just been proven wrong. You were right for the wrong reason. And I think it's probably the hardest thing to do, because the tendency is to just give yourself a pat on the back and say, I've been smart and brilliant and I've been proven correct. And I think that's a hard one.
Although Aziz, I would always rather be lucky than smart, if all my
no, completely agree, don't get me wrong.
All great points from both of you. I would just add that I think the career risk of selling a winner is just so large that it forces people to not sell, especially if you run an open fund. You can correct me if I'm wrong, Aziz. So our next question is...
Actually, I just want to add to what you're saying. It's a
Go
great
ahead.
point. If your portfolio is examined by your investors on a daily basis, I think it creates a bias to want to kind of showcase your winners because it looks good. And by contrast, I think there are many investment organizations where they have losers and they sell them not because they won't recover, but because they don't want to have to explain the position to their investors. And if they sell the position, then they can just say, well, it's sold, so why are you asking me about it? And I think that it's to set up the incentives of the investment manager in such a way that he's not biased towards doing that. And that involves, for example, writing very clear letters to your investors, as Aziz does, and seeking out investors who really understand what you're doing, who trust you, and where you can have a relationship with them, where you can explain to them that if a position is down, that you're not under pressure to sell it, so that you don't have to talk to them about it. It's down because, half the time things go down initially after you've bought them. So, and I would tell you that in building an investment business, figuring out those issues is almost as important as the actual investing, structuring your environment in such a way that you can make good decisions over time and not feel forced to sell out at the wrong moment, or buy something just because everybody else is buying it, or hold on to something that's overvalued just because you want to showcase it to your investors. And it's a fascinating area, but now we can go back to the question you're about to ask, Wael. Thank you for giving me the moment.
Well, I'll add, Guy keeps referring to my letters, but actually, and I don't know if his letters, I don't know if they're publicly available, but one of the things that he does very well that I've noticed over the years is he is very well, he goes out and really writes about his mistakes and puts everything out there completely transparently, accepts responsibility for the mistakes. And there are very few people who are both courageous and intellectually honest to the point that they're willing to do that. And I think just looking at how Guy has done over the year, I've certainly learned a lot from it. And it's one of the things I really admire about him.
Shukran. Thank you so much,
Have
Aziz.
fun.
Really kind of you. What I tell you, Aziz, is what I think that I've learned is that my best writing comes when there's blood all over the table. So, you know, it's like it's just, first of all, it's painful. It's almost like you're writing with tears in your eyes, because it's this sort of confession in a certain way. And when I've written well, I'm always scared of what the reaction will be, because I am afraid that people will, you know, it's like that first chapter in my book where I'm like, will anybody ever want to invest with me ever again once they know all this about me? And but what I've learned is that putting myself into the arena in that way actually most of the time delivers rewards. So every now and then it gets really painful, because it's painful to write, and every now and then somebody will come back at you and deliver the worst blow that you can expect from writing it. But you know, I don't want to get into British politics, but you know, Aziz and I both have a close connection to London. I was a classmate with David Cameron, and I shared tutorials with him, the former British Prime Minister, and he's embroiled in this Greensill scandal. And what I wrote to him, Aziz, was that I didn't write directly to him. I wrote via a friend who might show him the email, he might not. But we all have disasters in life, and that's a successful life has disasters. The question is, if you can be brutally honest with yourself and with the world about it, I think if you can do that, you can actually end up doing some good. And we'll see if it wasn't really advice, it was sharing my example. We'll see if he acts on it. I think perhaps not, but I'm open to being surprised and delighted. We'll see. Forgive me, forgive us, Abdullah and Wael, just a little bit of British politics there, just for fun.
No, not at all.
We love the discussions you guys have. So the next question is my personal favorite. What is the best and or worst investment you've ever had, and what have you learned from it?
I mean, I'll go first in this instance. It's easy to talk about both of them. One was the one that, I mean, it's not really an investment of my time and my career in a certain way, an investment of my reputation. The most important thing that we all have is our reputation. And I went to a place that I shouldn't have gone to work at. And I went there because I was greedy and because I liked the title of vice president and I wanted to make money fast. And I thought that I was, you know, smarter than everybody else. And that was a huge mistake that took me at least 5 years or more to recover from in terms of my career. And I say, you know, it's not technically an investment. It was a career choice, but you know, we should treat our reputation like it's an asset and keep investing in that asset and growing that asset and never ever doing anything that would damage it. And it's such a fragile asset that can be destroyed very, very quickly if you don't watch out. And for example, what happened to the guys at LTCM, what's happened to the guy at Archegos. I mean, I'd like to believe that if he'd understood what he was playing with, he might have done things differently. So that, you know, I think there's a lot to learn from that. The second one for me is there was investment that I made in a company that ended up declaring bankruptcy. They were a recycler of zinc, a company called Horsehead. And it was an extraordinarily painful 18 months because even though I could see that the situation was very, very likely lost, I felt the obligation to do everything I could to recover something for the equity. And it ended up with me flying to Delaware, where the bankruptcy case was being heard multiple times and making multiple submissions and paying lawyers. And we were close to winning something for the shareholders, but ended up not winning anything for the shareholders. I would say that I made some good friends through that. And actually, Aziz and I meet in a group once a month to talk about how to run our businesses and other aspects of our lives. And a member of that group, Matthew Peterson, is somebody that I met through that bankruptcy. But I write about, so Aziz, I don't know how you do it. I have a due diligence questionnaire. So if somebody decides they want to invest with me, we send them this due diligence questionnaire in which I write up my history with that horsehead investment, which is actually also in one of my letters to investors, I think, which are available. Aziz, you said some kind words about my letter. I wish I could publicize it, but I'm not allowed to. The regulatory authorities, in my case, FINMA, would call that marketing the fund. So the people who can see it are the people who sign up in the proper way. But over to you. What's been tough for you, Aziz?
I don't claim to have as good an answer for these two questions as Guy just had. I'm just gonna be relatively boring, I guess. And on the positive side, I think that
you are never boring. It's always warm and interesting. So
thank you, you're very kind, as always, Guy. On the positive, on the two biggest investments. So I've had two 10-baggers in my life so far. I hope to have many more, I hope. But the two are Microsoft and Visa. And I've owned them for about 10 years. Actually, I made what so far looks like the mistake of, back to the earlier question, of selling Microsoft last year when I thought it was very expensive and everything else was cheap, and I wanted to buy the other cheap stuff and should have held on. But and Visa, I've trimmed over time, again, because of valuation. And so far, that's also been an expensive mistake. But the flip side of it, in both cases, I did something that I was not good at probably 10 years ago, which is add to a position that's gone up a lot in price. So in both cases, I've continued to add to the position over many, many years. And you've got to be careful. You've got to do it in a disciplined way vis-a-vis your valuation. However, I think it's a bias that I had that took me a very long time to overcome, which is to add new money to something that's already gone up in price. So that kind of the lesson that came out of it. And I guess the related to it is that with certain kinds of businesses, you may want to look at the valuation at certain points in times and close your eyes and just ride it, because it'll work out over 10, 15, 20 years. So there is this, it's not with every business, but it's with some very rare businesses that can do that. On the flip side of it is the worst mistake. I think let's not get into personal life and the mistakes that you do in your personal life, but on the investment side, perhaps the biggest mistake in terms of, I don't think it was the biggest percentage mistake that I've ever lost, but it was at the time at least, and the biggest percentage of the portfolio that I've ever lost, which is we owned shares in Telefonica about 10 years ago, and it looked cheap to me. And long story short, it really did not work well. And then what I hadn't realized is that the business was changing, where one division, the legacy division, and the legacy part of the mobile division, which is voice and SMS, was slowing down or declining and was being replaced by data. And basically, you've got this two at the top line. Looks like you're replacing $1 per customer with another $1 per customer, but underneath that top line, the economics were very, very different, both in terms of margins, capital intensity, and so forth. And the combination with high operational leverage and high debt, to the point that we talked about earlier, was really toxic. So when you have a lot of operational leverage and a lot of debt, which, I mean, you just talked about airlines, that applies to airlines as well, mistakes can get really magnified very, very, very quickly. And I think the lesson that I got out of that, other than to try to avoid those mistakes, is to sell as soon as you realize that you've made a mistake, even if you've lost a lot of money. I think for many investors, there's a tendency to hold on and hope that the stock recovers. And by the way, had I held on, I think the stock eventually recovered at some point. But you know what? It took many, many years. And I would have, it's often that you don't have to make the money back the same way you lost it. Just accept that you've made a mistake and learn the lesson and move on, I think.
Wonderful. I'm sure a lot of our listeners will be learning a lot from these mistakes, and I would like to thank you both for sharing them. It takes a lot of courage for people to share some personal investment from the past. Knowing that both of you, going to our next question, like Warren Buffett, and by the way, he's a role model to me and to Wael and a lot of young investors. We would love to know what happened, if you can tell us, Guy, more about the lunch with Warren Buffett. What happened, what you learned, and even if Aziz, if you ever met Buffett, I would love to hear how is he in person.
I'll certainly give you some color on the lunch, but I would love to
Ty
hear.
is definitely the expert here.
No, but I'd love to hear if you've had any interactions with Warren and what they were like before I go into mine.
I didn't have a lot. I mean, I've only had 2 interactions. One is I met him when I was in university and he came and spoke and he was very kind. And then the other one, I wrote to him. I wanted to take something out of his letter and include it as a section in my letter 10 or 15 years ago, I think, maybe longer. And I wrote to him and I said, can I have your permission to reproduce this thing that you wrote? And he wrote a very kind email back and said yes. But Guy had a lot more, I think. And
you know, I can't speak, especially with this group, about the lunch with Buffett without talking about Monish Pabrai. Abdul and Wael, I don't know if you know that Monish Pabrai is from, he's Punjabi Indian originally, but he also grew up in Dubai for a significant period of time. His father was an entrepreneur in Dubai, and so he has a strong familiarity with your region. And so we know from my book, from what I tell in my book, that there's no way that I would have ended up being able to sit down for lunch with Warren Buffett had I not met Monish Pabrai. It needed his mind and insight because, you know, when he brought up lunch with Buffett, I said, why would one waste so much money? I mean, he's a great guy and all, but that's a lot of money to spend, so to speak. And sort of Monish Pabrai shared how it wasn't really about spending the money. The money was going to charity, and you got this kind of lunch for free. And he also explained, and I don't know how he knew this, but he knew that some of the people who'd had lunch already became, I mean, I don't know, friends or were invited into Warren Buffett's circle. So there was potential for other things to happen. And so, and you know, in the run up to the lunch, people came, so you had 7 spots, and what some people thought that Monish and I should do was auction off the spots and even make a profit off it. So, you know, if the lunch was $700,000, sell off each spot for $100,000 was your break even, so to speak. And Monish insisted, because my wife, my Mexican wife, had said, you know what, it's an expensive lunch. Why don't you bring some business associate? And Monish said, no way, we're going with our wives and with our children. And so that was, you know, that was a very, very smart insight from Warren Buffett. And he made it clear before the lunch that we were not there to get advice or to kind of dig him for information. We were there to say thank you. And so, and I think that, you know, when I hear you guys speaking Arabic, and actually it's one of the reasons why I love having Aziz in my life, because there's this Middle Eastern hospitality and warmth and generosity that is really very, very special. And I think that Monish brought that to the lunch. And I think that I suspect that he learned it in the region. And so I think that Warren Buffett was disarmed. So he didn't come sort of looking to protect himself from unfair questions or from intrusions or for attempts to sell him something. He knew he was just getting a family lunch where he was going to be thanked. And we sat Monish's daughters either side of Warren, which he also loved. And I started off, I was calling him Mr. Buffett this and Mr. Buffett that. And at some point he puts his hand up to me and he says, Guy, to my left and my right are Monish's children, and they're already calling me Warren. And by the end of the lunch, you're going to be calling me Warren. So why don't we just start now? Which was just amazing. And so, I don't know why I come to this, but if you read the Alice Schroeder biography of Warren Buffett, Aziz, you're going to help me with the name of the book. Snowball. Alice describes a number of situations where Warren was very careful with small amounts of money, sort of like holding on to a penny or holding on to 10 cents that somebody had given him. And I'd expected to see that, but I did not see that at all. It just stuck in my mind that at the end of the lunch, he gave a tip to the waiters, which looked to me like it was several $100s. And that may seem to be a small detail, but I think that it's really important for me because it shows that no matter who's in the room, including the waiters, he was thinking of them, and he knows that they know who he is, and it would have been distasteful for him not to give them a huge tip. After all, he's a billionaire. Similarly, by the way he approached us, he actually said at some point, he said, well, you guys have spent a lot of money to do this, and I'm determined to make sure that you get your money's worth. And so he came to the lunch. We read, Monish and I, that Tim Cook had done a charity lunch auction, the CEO of Apple. But the way he ran that lunch was that, the winning bidder could meet him at the cafeteria of the Apple headquarters for no more than 60 minutes over an informal lunch. Warren Buffett, we were at a private table in a very well-known steakhouse in New York City, and he stayed with us for the best part of 3 hours, perhaps even beyond 3 hours. He was there for as long as we could make the lunch last. He wasn't going to try and cut it short in any way. So whether it was with us or with the waiters even, he was looking to leave the people he'd interacted with feeling absolutely great about the interaction. And that lesson has gone really, really deep into, in fact, I don't think it went deep enough, but it's still seeping in, is this idea of being a person where every person you interact with, every organization you interact with says, wow, I'm really glad that person is in my life. Because if I got the chance to help, they were so kind to me, they were so generous, they were so easy to deal with, that if I got the chance to help them back, I would. And, it's still, you kind of want to believe that somebody who's generated an enormous amount of wealth did it because of some kind of clever moves. And in Warren Buffett's case, he is an unbelievably smart guy. But in a certain way, the key lessons are moves that we can all make. And they're moves that are so special because first of all, they help to make us successful long-term, but they also don't detract from anybody else's success. In fact, they actually help the success of people around them. Having said that, and I would just add as a last point and you can come back to me for more if you like, is that, and I don't know if it's just, I was very nervous before the lunch. I was so nervous that I got sick. So I had a slight cold at the lunch because I'd worked at DH Blair. I'd worked at this place, which was a snake pit and which I shouldn't have worked at. And I had this enormous fear that he was going to say, you're that sleazy investment banker. I so wanted him to like me. And I was so afraid that he wouldn't like me. And, but so I was very nervous, and I was sort of on heightened alert. But I did feel like I was in the presence of an extraordinary mind, a mind that, and it was very painful for me because his mind, I felt like I was in the presence of a mind that moves way faster than mine. And that was painful for me because in addition to wanting him to like me, I had this idea that maybe after the lunch I'd say, well, yeah, he's a bright guy, but so am I. You know, he's no smarter than I am. I'm no smarter than he is, something like that. And I think I came away with the kind of like the grudging realization that this guy certainly had a higher IQ and a faster mental clock speed than me. And, you know, I always joke that Warren Buffett says that you don't need, once you have an IQ of 130 or 140, you can give away the extra IQ points. You don't need them in order to be a good investor. And my answer to Warren Buffett is, well, that's great. Just please give me all your IQ points because I need every IQ point that I can get. So his brain moves extraordinarily fast. And I do think that it's an advantage. And what it forced me to do, and I think that this is a valuable lesson for everyone, is that, the way I like to put it is, God is not going to punish me for not being Warren Buffett. You know, I'm not required to be Warren Buffett. I need to be Guy Spier, and Guy Spier has talents and strengths and abilities that Warren Buffett doesn't have. And, you know, the other statement that I really like is that, how do you beat Bobby Fischer, who was this famous and very successful chess player? How do you beat him? And the answer is, play him at anything that isn't chess. He's only good at that one thing. And actually, I would tell you, so in the realization that I don't think that I'm capable of being such an extraordinary investor like Warren Buffett. And actually, what I think that I see from close observation of Warren and Charlie is that Warren, because of the way his mind works, is very, very happy living really a very narrow life. And he's got a very, very narrow kind of reading. And that works for Warren Buffett. So I would not want him to change anything about the way he lives his life. But it helped to free me because I was trying to be Warren Buffett and I could never be Warren Buffett. And actually it freed me up to explore some of the things that I am. So for example, I love living in different cultures. I love learning languages. It kind of allowed me to wake up one day and say, why actually am I living in New York City? I could be living in Zurich, Switzerland. So it allowed me to go and become myself. So there's a little bit of insight into my lunch with Warren Buffett. One last thing, forgive me, Abdullah and Aziz, is that obviously it was a very expensive thing that I did. I invested the best part of $250,000 for 3 hours with Warren Buffett, but as you can see, it had such an enormous impact on me. And so what I've learned is that when you identify somebody who's extraordinary to you, if I identify somebody who's extraordinary to me, and I can see that I resonate with them and that I have a lot to learn from them, there is absolutely nothing wrong with, in fact, it's very smart to invest time and resources to get into the same room as them, even if that involves flying around the planet. Because getting into the same room as somebody is a very, very powerful way of learning from them. And, that lunch had such a big impact that I've done it a few times. I mean, I will, from time to time, I'll just get on a plane and fly out to California and visit with Monish because I think that it's been beneficial to me. And the place where I know I'll meet Aziz probably every year now, between now and when we die, is this ski resort in Switzerland. And I'm always it's so exciting to see the people who fly in there. And, they're not flying in for the snow. They're not flying in for me or Aziz. They're flying in for one or two people that are really important and special to them. And so, so some insights from the lunch. Back to you.
That was very great, Guy. I think you touched a bit on my next and final question, which is what piece of advice would both of you give to newcomers in the field of finance and investment?
Can I suggest something? I'll answer first, and then Aziz answers, and then Aziz gives a message in Arabic, because many of the listeners will be from the Middle East. No.
Yeah, that would be very great. Yeah.
Yeah, we're good with that. So, so where I would go is, so I have a niece who's based in Houston, and I said to my niece that, and if I didn't say it, I would say it, and in a certain sense, I'm saying it to her now, is that I would give up every single dollar that I have invested in Aquamarine Fund if I had to, in order to pay for her and our children's education. I think that this sort of investing in oneself, whether it's formal education or it's courses on Coursera or making the effort to go and be in the presence of somebody who's a great teacher, is the most important thing that one can do, more important than investing in the stock market. And if you're investing in the stock market and you're not investing in yourself, especially if you're under the age of 50, I think that that's probably a mistake, and the real returns will come. And I think that what I actually get most excited about in life is not, I do like the investing, but even more exciting for me is investing in myself, my knowledge, and my relationships and my network. And I think that the reason why I say that is that we talk about resilient wealth creation. We want to put ourselves in a position where, however the world turns out, we will become more wealthy and happier and wiser. And, to be very rich in the stock market, but to have horrible relationships and not to know a lot would be a great shame. And I think that the investment in oneself and one's network ought to come first. And if you do that well, the riches in the stock market will come. So that's my piece of advice and lesson. And I'm sure that now that Aziz had time to think about it, he'll come up with something really good in English and even better in Arabic. Go ahead, Aziz.
Well, my answer is, I thought I had a good answer, but now we just used it. But there's not much that I would add. I think, to me, my advice to anyone, regardless if it has to do with investing or not, like Guy said, is just always keep learning. Never lose that curiosity. Keep questioning things, and to some degree, I think, and if you want to be an investor, then that's definitely perhaps the most important skill that you could have. This, because the second you stop learning, I think learning in life and investing is like running on a treadmill. You just cannot stop. If you stop, you'll fall and you'll get hurt. And I find that also widen what you learn and what you read, and don't just read business books. I find that kind of broadening your perspective and kind of helps you. Munger calls it a lattice work of mental models, which is an absolutely brilliant way of describing it. If you read history and you read philosophy and you read physics and you read biology and you read in different fields, and at the same, and you start to build these mental models in your mind, and you can do cross connections, whether it's about investing or about life or whatever it is that you choose to do with your time on Earth. And then the other thing I think that I've learned that Guy just mentioned as well is surround yourself with people who are smarter and better than you, because as you spend time with people, whether you like it or not, it will rub off on you. And if you spend it with people who are bad people, or that will turn you into a bad person eventually. And if you spend time with good people and smart people, that'll also make you smarter and better eventually over time, whether you try or not. There's this just human nature, I think, that happens. To always seek, I think, to spend time, like Guy said, with smarter people, but also just good people, people who are good human beings, and it will make you a better person over time. And regardless of whether you're an investor or how much money you want to have or whatever it is that's driving you, the worst thing I think that could happen to you is be quote unquote successful in terms of having money, but be hated by people for being a jerk, or just, I don't know, sitting on your deathbed thinking that you've wasted a life just being a horrible person. There's just, what's the point? So I think that's the other thing. And then if you do want to do get into investing, I would say find an investment strategy that fits your personality. And you're all different. And for some people, what I do, for example, could be the most boring, unproductive use of their time, and vice versa. So it needs to fit your personality, or I think it's just, you won't be successful at it, and you probably won't be happy at it. And again, what's the point? So that's kind of my 2 cents on this topic. And what am I supposed to say in Arabic? Because I forgot, guys.
I think I think it's fun for. I think that we know if I for the listeners, and it might be a global audience, it will be in a global audience, but many of them will have Arabic as a mother tongue, and it's just nice because in a certain way, Aziz, you don't realize it yet, but you're also a teacher as well as an investor, and the closer people feel, the more the lessons go in, and to the extent that they can connect to the side of you that is Saudi Arabian, the lessons will go in more deeply. I just want to tell, before you prepare yourself in Arabic, that Aziz, the part of the reason why I wanted to involve Aziz in this is that if you should surround yourself with people who are smarter than, wiser than you are. And I see Aziz doing, I see Aziz growing in wisdom every year, and so I like to surround myself with people like Aziz. But
and vice versa. I mean, that's.
And I'm delighted to make the connection with the two of you as well.
Well, you mentioned earlier the whole Value X thing, and I actually, when I heard about the Value X thing, which is the conference we go to, and by the way, the guy is modest, but he organizes and him and his team doing just a phenomenal job putting it together every year.
Aziz is modest. I just want you to know that I used to moderate the conference, and now Aziz helps me to moderate the conference. Just that you know. Sorry, back to you, Aziz.
But the point, the point is, I think. So when someone told me about it, I called up friends, tried to find a way to get to you. And I think eventually, if I'm not mistaken, a friend of mine, Hassam Shabukshi, eventually did the intro. And I said, I've heard you do this conference. Can I come? and you were generous enough to let me come, and been going ever since. And it's my favorite trip of the year. I look forward to it. It's one of we were lucky that we had the 2021 right before kind of COVID, and unfortunately it didn't happen 21, but really looking forward to going back in next January. I think and now it's Ramadan, so to me it's always a good time of the year. It's one of the things that actually my wife taught me. And we try to pass on to our kids. And I think people, unfortunately, a lot of people kind of look at Ramadan and just think about the fasting and just the physical aspect of it. And what we're trying to talk to our kids about, like I said, it's something that my wife has come up with, is just take it as an opportunity to reflect, take it as a time of the year to think about everything that you have in life that's good, and also think about ways where you can improve, but also just think of everything that you have that others don't have. And I know that at the heart of it, fasting is supposed to be about that basically you have food and others don't. But I think we've tried with our kids to widen it beyond that. And I think, to me, that's the essence of the whole month at its core, is just to be thankful for what you have, think about those who don't have it, and think about how you can give back in life in any way that you can. It doesn't have to be just money. It may just be by being a nicer person, being nicer to people, being helpful to people, giving half an hour of your time to someone who needs advice or help, whatever it is that you can do in life, and don't expect to be paid back. And this, regardless of your beliefs, whatever you believe in, whether it's Allah or any God that you believe, or nature, or whatever you want to call it, it seems to come back to you. Like you put good out there, and seems to come back to you it seems to come back to you soon, and relatively soon in life. So invest in giving, and I think you'll get it back. And maybe that's what I would say in Arabic, as and I wanted to say it in English first, just so Guy knows what I'm going to say. And
maybe it helps set up Aziz to answer in Arabic if you pose a question in Arabic. So it kind of like
yeah, sure.
We need to end.
Yeah, we can do that. Why would you like to do it?
Sure, no problem. شكرا أول شيء عبدالعزيز إنك جيت معنا المقابلة. آخر سؤال ممكن، وش أكثر شيء تعلمته من إدارة الأموال خارج السعودية مثلا؟ يعني هل في اختلاف كبير؟ هل في حكمة ممكن تعلمنا المستثمرين الجدد ولا لا؟
ما أعتقد صراحة. أول شيء شكرا لكم، شكرا للوال، شكرا لعبد الله، والشكر جزيل لجاي سبير، لأنه هو اللي كان أحد الأسباب أن أنا موجود. وعلاقتي معاه صراحة كانت يعني كانت وما زالت من العلاقات اللي أعتقد تضيف الكثير لحياتي، وتعلمت كثير منه صراحة. جاي كريم جدا بوقته ومساعدته لأي شخص يعني مهما كان، وأعتقد هذه من الدروس اللي كانت جدا مفيدة لي في الحياة. من ناحية إدارة الأموال ما أعتقد تفرق، المكان ما يفرق. إذا في فرق بسيط بين، وأعتقد هذا تغير كثير، بس يمكن قبل يعني أنا بديت أدير أموال تقريبا قبل 20 سنة. هذه الجزئية أعتقد تغيرت كثير من خلال الفترة هذه. يعني لما بديت ما كان موجودة. طرقنا الموضوع إنه كيف حاول إنك تحيط نفسك بناس أذكى منك وأشطر منك وأجود منك أخلاقيا بكل ما تحمله الكلمة من معاني. دائرة الناس في المجال هذا أوسع في مكان زي لندن، وقدرتك إنك توصل لهم وتتعلم منهم أكبر. لكن الشيء هذا كثير تغير في السنوات الأخيرة. أعتقد جمعية CFA في السعودية لما أنا بديت كانت جدا صغيرة، والحين ما شاء الله صارت يعني كبيرة، وعندهم إيفنتس وأنشطتهم جدا رائعة. فهذا صار تغير جذري. المجال العمل نفسه تغير وصار أكثر عمق، وصار في ناس أكثر عندهم الخبرة في المجال هذا، فتقدر تتعلم منهم. هذا يمكن ما كان موجود قبل 20 سنة، بس الآن موجود، ويمكن هذا أكبر فرق. بس غير كذا ما أشوف إنه في فرق صراحة.
يعطيك العافية. شكرا عبدالعزيز، شكرا جاي. Thank you all for coming here and giving us your time. I hope we didn't take much time. So I think we will end it now. So thank you all for being here. Thank you.
شكرا.
كل عام وانتم بخير.
شكرا both. I personally learned a lot. Thank you very much both. That was insightful.
شكرا لكم على هذه الفرصة.
شكرا لك. يعطيك العافية.
مع السلامة.
أمان الله. مع السلامة. Thank you, Guy. Have a lovely day.